You have a 5-year-old kid, you can give them an acre of land in New York City, that's capital, and you can say in 10 to 30 years, you can either sell this land or you can refinance this land, and in the meantime, there's no cash flow. That's a capital investor. On the other hand, you can also give the kid an annuity. This is an annuity and it pays you $10,000 a month forever. That's credit. If you want to give the kid $10,000 a month forever, you give them a credit instrument. If you want to give them the ability to get rich in 30 years, you give them the capital. Bitcoin is capital. It's volatile, it's high performance. There's a lot of people that don't want it. The world is built on capital, but the world runs on credit. There's volatility in the market, there's sound and there's fury, there's skepticism. You know, there was skepticism about electricity, there's skepticism about automobiles, about airplanes. Every technology's got skepticism. People weren't even sure they liked nuclear power for the past 50 years, right? We stopped nuclear energy from 73 to 2023, and then all of a sudden they decided that infinite clean energy was probably not a bad idea again. So there's always going to be skepticism of the new, but I wouldn't get caught up. I wouldn't be afraid or I wouldn't be cowed by the volatility. The volatility means this is the most powerful, vibrant, useful thing in the entire capital market. That's why it's volatile. And there's energy there. You can harness the energy if you're not afraid of it. Don't run away from the fire, run toward the fire. That's what I would say to everybody. If you can't handle...
There is a structural shift happening right now in crypto markets. This is not random volatility. It is a tectonic recalibration of capital, liquidity, and perception. Bitcoin has been consolidating in a tight range near its yearly high, just shy of the $100,000 threshold. It sits here not because the cycle has ended, but because capital is recalibrating where and how it participates. To understand why this matters, consider the institutional signals now emerging. Major macro research houses and crypto-focused institutions have outlined yearly scenarios that range from $150,000 to $250,000 for Bitcoin, and in rare extreme forecasts, even higher. Those projections are not pulled from thin air. They are anchored in ETF adoption trends, regulated inflows, and long-duration positioning by legacy allocators. This asymmetric range, from conservative to hyper-bullish, reflects a dual reality. Bitcoin remains bound by near-term technical resistance, while long-term structural demand is mounting beneath the surface. Over the past week, spots of fresh institutional demand have been recorded through ETF channels, and the market's internal odds favor Bitcoin holding above key psychological support levels. That tells us something important. Capital is still accumulating, not fleeing. Technical momentum alone does not write the full story. What is unfolding is deeper, a transformation in who holds Bitcoin and why. In prior cycles, retail emotion dominated price swings. Today, regulated vehicles are anchoring capital flows. Advisors, pension allocators, and macro funds are increasingly framing Bitcoin as digital monetary capital, not a speculative token. Even as Bitcoin trades below the century mark, macro analysts are doubling down on cyclical rebirth narratives, pointing to global liquidity, easing monetary conditions, and continued adoption as catalysts that could push prices well beyond 6 figures this year. And according to Michael Saylor, this is just the beginning of the crypto bull run. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Good thing. What is the company doing? We're transforming capital to credit. You have a 5-year-old kid, you can give them an acre of land in New York City, that's capital, and you can say in 10 to 30 years, you can either sell this land or you can refinance this land, and in the meantime, there's no cash flow. That's a capital investor. On the other hand, you can also give the kid an annuity. This is an annuity and it pays you $10,000 a month forever. That's credit. If you want to give the kid $10,000 a month forever, you give them a credit instrument. If you want to give them the ability to get rich in 30 years, you give them the capital. Bitcoin is capital. It's volatile, it's high performance. There's a lot of people that don't want it. The world is built on capital, but the world runs on credit. And so in order to convert capital into credit, you take BTC currency and you make it USD, or you make it euros, or we could create JPY. You strip the risk by over-collateralizing it. You damp the volatility by giving it a par value, a liquidation preference, and by managing, say, the dividend rate. You extract or distill the yield. You can set the yield, say at 10% or whatever percent you want, and adjust it. And then you compress the duration. The capital investor, if you own Bitcoin, I say you got to hold it for 10 years, you'll get rich. But you get no money between now and then. The credit investor is, I'm going to give you immediate gratification. I'm going to start giving you cash dividends next month, every month. Okay, there's a place for both. In fact, the average person has certain money they need to have in credit and other money they need to have in capital. What we're doing is transforming digital capital to digital credit. And we've done it and created these various digital credit offerings. Strike is structured Bitcoin. It pays you a yield and gives you upside while you wait if you want the best of both worlds. Stride is super high yield, long duration credit. It's actually paying 12.9% effective yield right now. If what you want is max cash flow, then you would want something like this. Strife is super senior credit, so it's senior in the capital structure, has the most governance rights and liquidation preferences. It pays less. If you want investor protections, you get 9%. If you're willing to waive them, you get 12.9%. There are two different sets of investors. The investors that buy the one won't buy the other. We created both of them intentionally. And then we stumbled on something. Necessity is the mother of invention. We stumbled upon this observation that if you actually fund the dividends by raising capital, either through equity or through the derivatives market or the BTC market, then the dividends you pay are return of capital, which means they're tax deferred, which means you don't have to pay the tax on them. And this is profound, right? We created a way to pay you dividends where the dividend tax rate is 0, not 20, not 30, not 50%. And of course, the company then sells the credit to buy the Bitcoin to create this amplification. So if you're wondering, why does the equity have value? The equity has value because we're able to create the credit. And the more credit we sell, the more BTC yield we generate, the higher the equity value will be. And so let me just break this down with a few quick observations. First, there's a revolution in credit markets. This is a $300 trillion market. Why is digital credit better? Because you're building it on an appreciating asset, Bitcoin, not a depreciating asset, not a rusting warehouse or a product or a service. It's better because it's transparent, homogeneous, and continuous. We update the credit model every 15 seconds. It's not like 10,000 mortgages wrapped into a mortgage-backed security. It's not like corporate credit or sovereign credit. It's better because it's equity, not debt. Bank credit is debt. Bank deposits are debt. Corporate credit is debt. What that means is they amplify risk to the issuer. Equity mitigates the risk. It's technically impossible to go bankrupt if you're actually creating amplification with equity because the equity never comes due and the dividends can only be paid out if they wouldn't make you go bankrupt. The perpetual nature is another big change. We'll pay you the dividend forever. How do we pay the dividend forever? We invest the money forever. We're investing the money in the crypto economy forever. We're paying the dividend forever. Every other form of corporate credit is short duration. And then we tacked on this idea of taking it public. And because we took it public, it's liquid, it's global, it's easy, it's branded. There's a word, stretch, STRC. Anybody can buy it anywhere in the world. And we create the credit digitally. If you give me 500 million, I create 500 million of backing collateral, and I do it simultaneously before the day is over. Imagine you wanted me to create $500 million worth of buildings in a single day. You see, we're running the investment cycle in one day, and it would take a real estate company 5 years. And it would take a company years. So the speed at which you're doing this is unprecedented. And then if you do it in a treasury company with that model, it all becomes tax deferred. And so what you see here is, on the left, traditional credit can pay you 2, 3, 4%. We can pay 10 or 12. We can pay higher dividends because we have a more efficient product and we have innovations in that credit. And that's based upon our business model. What is a Bitcoin treasury company? We sell securities to acquire capital. We issue digital credit, and that's tax deferred, and then we pay the dividends tax deferred, and the capital appreciates tax deferred. It's triple tax deferred. This is the most efficient, scalable fixed income generator in the world. Like there's no other type of company in the world that can generate billions or tens or hundreds of billions of dollars of dividends tax deferred. You can't do it with oil and gas. You can't do it with real estate. You can't do it in the traditional way, selling products and services. So the breakthrough is based on digital capital and this new type of business model. This is the revolution. We're basically going to digitally transform the banking industry, the money market industry, the credit industry. And it's not just stretch. Every digital credit instrument is so much better than every conventional credit instrument. It's not even funny. Like, look at junk bonds. They pay you 6%, and our instruments are tax equivalent 14 to 20. Or look at private credit. It's 7. It's opaque. It's heterogeneous. And of course, look at the entire world. Stretch is a 17% tax equivalent yield. The money markets in the US are 4%. In Korea, they're 2%. In Europe, they're less than 1%. In Singapore, 1%. In Japan, 50 basis points. In Switzerland, they're negative. So when we talk about digitally transforming the world, what we're really talking about is fixing the money and fixing the banking system and fixing the credit system. And remember I said the world runs on credit? Okay, well, how are you supposed to give your kid an annuity in Switzerland or Japan when the bank's offering you nothing? Right? How do you get 10% in Swiss francs or 10% in yen? And the answer is digital credit. And all of these companies that are transforming the world, they're going to go into Japan, like Metaplanet, or Switzerland, and they're going to go into Korea, and if it's not our company, it'll be another local company. And the truth is, the world, the world wants a 10% bank account. So I'm going to make one point, right, which is if you walk down the street and you ask 100 people, what do you want? Do you want to get 30 or 40% a year with 40 volatility? Between 1 and 5 say, yeah, I could put some of my money into that. But a lot of people are afraid. If you ask the average person, would you like a bank account that pays you 10% tax deferred? Everybody wants that. So if you're not sure what you want, you probably want something like Stretch, STRC. And if you think about the implications of this for the digital economy, what this means is that on a foundation of Bitcoin digital capital, we're going to see digital credit spread into every single market, and it's going to fix the banking system. It's going to fix the money market system. And it's probably going to reset the cost of capital for corporate credit, private credit, other types of credit securities. The winner is the investor. The winner is the digital economy. The winner is the Bitcoin holder in the Bitcoin community. The loser is any bureaucratic, antiquated oligopoly that wants to keep your money and pay you nothing. And that's a lot of different systems everywhere in the world, but we're reforming that system to the benefit of humanity. And you're all on the journey with us, so thank you for your support.
A growing cadre of forecasters are now positioning $150,000 to $250,000 ranges as plausible by late 2026, assuming institutional flows remain robust and regulatory clarity improves. At the same time, bearish voices remain audible in the background. The key takeaway for long-term observers is sober. Bitcoin's current price action, hovering in the high 90K range, is not a collapse. It is a transition. Capital is shifting from short-term volatility bets into persistent real-world allocation. Regulatory dialogues, ETF inflows, and institutional purchase agreements are evidence of this layering, not random headlines. For those watching price forecasts, recognize this. Predictive ranges of 100K up to 250K and beyond are not ultimatums. They are potential outcomes contingent on where real capital chooses to anchor itself, not just where traders think price should go.
Let's start with an observation. There's a revolution in the capital markets going on. And that revolution is impacting the capital markets for currency globally. It's impacting the capital markets for equity. It's impacting the capital markets for credit. It's impacting the derivatives capital markets. And the basis of a lot of this starts with Bitcoin. And it starts with the embrace of Bitcoin by the global financial community. So Bitcoin is emerging as digital capital. And why is it digital capital? Because the President of the United States, Donald Trump, has styled himself the Bitcoin president. He's declared he wants to make the United States the crypto capital of the world. He's decided he wants to lead in digital innovation, whether it's digital assets, digital capital, digital finance, or digital intelligence. And you can see that it's not just rhetoric, because he's appointed a cabinet, and that cabinet consists of an incredible array of digital advocates. The Vice President of the United States is an advocate. The Secretary of the Treasury, Scott Bessent, is an advocate. The head of the SEC, Paul Atkins, is an advocate. And not just the financial regulators, you also have non-financial regulators like Tulsi Gabbard, Kelly Loeffler, Robert F. Kennedy, even the head of the FBI or the head of Commerce. You've got an unprecedented support for this asset class across those people running the entire government of the United States. And this is a big deal. We've come a long way in 12 months. The second thing that's happening is that for Bitcoin to emerge as digital capital, you need the banking industry of the world and the banking establishment to embrace it. And they were fairly hostile to the entire crypto industry until about a year ago. And even a year ago, with the change in administration, there was uncertainty as to whether or not the banking regulators would actually make good on the campaign promises of the Trump campaign. And what we've seen is they have. There's been a series of announcements by Treasury, by the OCC, by the FDIC, by the Federal Reserve, and even joint bulletins from all those financial regulators. The sum total of them to say crypto is good, Bitcoin is good, it's okay to bank it, it's okay to lend against it, it's okay to custody it, We know that the previous administration punished banks that engaged in crypto activities. We're not like them. There's a 180-degree sea change. So banks are the most bureaucratic, risk-averse institutions in the world for good reason. You would think that from the point that the tone at the top changed 180 degrees, it might take a bit of time. I mean, for all the banks in the world to embrace crypto, to embrace Bitcoin, in 4 to 8 years would be fast. What you see here is it's happening much faster. What we've seen is BNY Mellon, PNC Bank, Citibank, JP Morgan, Wells Fargo, Bank of America, Vanguard, all of these have flipped from a hostile, negative, or skeptical view to a positive view in the last 12 months, right? We have announcements. Schwab is going to custody Bitcoin and extend credit against crypto assets early next year. Citi is doing the same thing. It used to be, I couldn't get a loan against Bitcoin from any major bank. And now, if I counted the top 10 banks in the United States, 8 of them are actually engaged in crypto lending, and they've all flipped their stance in the last 6 months. So the first big idea is you now have digital capital, a store of value. But that's just the beginning. That is the basis of an entire digital finance and digital credit industry. And all of these companies capitalizing on this can do lots of different things. You can rethink insurance, you can rethink banking, you can rethink trading, you can rethink all sorts of finance. We have focused upon rethinking credit. And so we are the first digital treasury company. What do? We created a capital balance, about 650,000 Bitcoin as of now. And we've acquired that consistently over the past 5 years. We're acquiring a huge amount of capital because we want to use it to create an extraordinary new kind of credit. Right now, we're the 5th largest treasury in the S&P 500. We're climbing our way. I think we'll be number 2 in the next couple of years. And in 4 to 8 years, we expect to be number 1. And we're doing that because we are positively polarized to capital. If you look at this chart tells a story, which is every company on earth, if it's conventional, is capitalized on money markets. The money markets return about 3% a year. That's the conventional finance strategy. But if you were to capitalize on Bitcoin, you'd be returning 47% a year. It doesn't take a rocket scientist to see that if the cost of capital or the hurdle rate is 14%, that's the S&P index, then any company capitalized on money markets is destroying shareholder value as they accumulate capital. But any company capitalized on Bitcoin is increasing or creating shareholder value. So when I say we're positively polarized, what I mean is every company that capitalizes on digital capital can raise more money and get more powerful forever. And they're competing against companies that are capitalized on fiat currency or conventional money markets that are getting weaker the more capital they carry on their balance sheet. So conventional wisdom is decapitalizing companies. Digital wisdom is recapitalizing companies. The secret to our success is we simply raise capital at the cost of credit, 6 to 12%, or the cost of equity, 14%. And then we buy something appreciating 47%, and that's how you get to a 65% return. We raised 20.
Is Bitcoin's narrative still about retail psychology? Or has it quietly ascended into the realm of macro capital markets, where liquidity, regulation, and institutional strategy drive the long-term trajectory? The market structure suggests the latter, and as capital continues to find regulated crypto corridors, price reactions will become more structural and less cyclical. That is the quiet revolution, and the next major breakout, whether above $100,000 or toward the higher targets, will be the market revealing which direction capital actually decided to go. That's all we have for today. Please make sure to like, share, and subscribe, and we'll see you all in the next video.